could also, if we get an enough amount of money, we could trade our money for our happiness.
Okay. Okay.
That's it, I
Can I
guess.
can I define money?
Yes.
Yeah. First of all, time is equal to money.
Yes.
Here, time is equal to money, but money does not equal to time because time is ultimate. Because if you have time, you can earn more. But if you have more money, you can't earn time. So, time is money. So, play with the time. If you play with the time and if you utilize the time, it will grow. So, in mutual fund, you need to give two things. First thing is time, and next thing is money. If you in our every life cycle, in our life cycle, we are in a trap called time and money race. Time and money race means if you give time, I give you money. If you give money, I give you time. But in the only in three situations, this scenario is different. Yeah, first scenario is school, second scenario is investment, third scenario is theater. And in school, normally, if you give time and money, they will give knowledge. If you go with theater, if you give time and money in theater, they will give entertainment. If you give time and money in the investment point of view, they give you freedom of life, or otherwise freedom like what we say, planning of future, planning of future. So here the point is, when you give time and money in these three scenarios, you will get more value and also more growth in the point of knowledge, in the point of entertainment, in the point of future planning or of financial freedom. You got the point, right?
Yes. Sounds great.
Yeah, normally we save money and we spend money and we investment. Already we have saving. So why we need to invest? And we spend, normally we spend, that's okay. Already we have savings. Why we need to go to investment? Why need investment means we have a thing called inflation.
Yes.
If your savings is done, the inflation eats your money, eats your
Yes.
savings. So that's why investment came to the picture. So that's why
Okay.
investment came, because in saving there is no compound effect, but in investment we have compound effect.
Absolutely. Absolutely. I
Yeah,
totally agree with it.
yeah. In investment we have compound effect, so that's why we can beat the inflation every time in investment. By using savings, you can't beat the inflation, because in our India inflation is 5 to 6%, but FDs are 5%. How can you beat inflation then? So
Yes, we cannot beat inflation through FD.
So because five FD is 5%, recurring deposit is 5%, but your inflation is 6%, you unable to beat the inflation because you are 1% behind the inflation. That means today's 1 lakh is tomorrow's 35,000. So here the point is, first we need to take a word from Warren Buffett that don't save what is left after spending, but spend what is left after saving. Normally we need to save first and next spend, not like spending and saving. So in
Okay.
investment, the major motive is saving first, spending next. In saving point of view, spending first, saving next. You got the point, right?
Okay.
In investment point of
Yes.
view, saving is first, spending is next. In saving point of view, spending is first, saving is next. So here the point, and also what I explained. See, the impact of inflation is 5% every year. That means today's 30,000. If you want to buy a product with 30,000 today, the product price will increase to 80,000 in next 20 years. That means if you have 1 lakh today, that will decrease to 35,000 in near future. It will become 15,000 in 15 years. It will reduce into 80,000 into 5 years. Now here the point is not reducing in the money point of view, in the inflation point of view. If you have a
Yes.
product like the iPhone, want to purchase 30,000 today, it will cost 80,000 next month. but your money is decreasing, the inflation is increasing. So the savings got a new opportunity called investment because of this impact. Normally, investing has a safeguard against inflation means we need to do first start saving, progress the saving to investment. You, only saving is not good because when you save, you can't beat it. So progress the savings into investment and put money to work for you. And the point is, if you want to work for money, you spend time, you give your efforts full. But if money want to work for you, he don't normally he interviews normal. For example, if you want to work, a employer will interview you and he will ask questions and you need to reply it, and if he likes you and he will joins you. But in the point of working money for you, money don't get interviewed, money will interview the person. Like if the product is good, if you ask questions like if the product is good, if the system is good, then only it will join the system. If anything happens, it will come back. Like you work hard to earn money, so but make money to work for you is good thing. Hello.
Yes, I'm here, I'm listening.
Yeah. Normally, in the investment, we have benefit of power of compounding. I already discussed. In saving, we don't have power of compounding because
We
compounding
can't beat
means
inflation.
every time it will be multiplied. For example, today's
Yes,
10 rupee increase to 1%, that is around 10.10 paisa. Tomorrow, it is not 10, once again 10 paisa. It should be 10 rupee 10 paisa into 1%. That should
yes,
be around 10.11 paisa or 10.12 paisa. It will be recurred. So in
yes,
investment, power of compounding is the basic thing and also main thing. If you want to invest, you need to check for it. If this happens, then that is called investment. If does not happens, power of compounding is not in that stream or not in that sector or not in that what we say is cyclic thing, that is not investment, that is saving part only. So first you need to save the money and next progress the saving into investment and put the money to work for you, because money can't interview by others, he only interviews others and get it invested in that company. So you
yes,
work hard to earn money, so make the money work hard for you. And the point is, today's my salary is around daily 3,000. Okay, and I don't have any investment, so my time value is 3,000. If I have investment and around 6 lakhs, I think I have investment. Today I got 6,000 something, so that my time value increased. So my time value is 3,000 plus 6,000. Total 9,000 is my time value. If you work for yourself, it is 3,000, and if money works for you, it is 6,000. So combined, it is 9,000. If only work for you and you only work for the money, then my value is 3,000 only, right? Basic thing is
yes,
that. So every time my value got increased because his power of compounding is affecting. Because today's 6,000 is not tomorrow 6,000. Something will be increased because every time the higher value of the thing will be multiplied with the percentage of the return. And normally, what is financial planning? Financial planning means defining the financial goal, asset, access the financial situation. Normally, you need to access your situation first. How the situation of your financial sector, you need to stream that. And next, you need to assert allocation part, and next invest accordingly. And last part is monitoring. You need to monitor it, review it, modify it, and financial planning is required for this. Because if you sit ideal and thinking that it will increase, so it can't increase. You need to do monitoring, review, and modify. Then only it will give you best value. And compared to investing and keeping ideal, it will create more value. And why is financial planning important? Means to reach financial goal faster in a disciplined manner. In investment, we have a disciplined manner. Look for the long term only, not for short term, not for 2 months, 3 months perspective. You need to look for more than 5 to 7 years perspective. Then only the financial goal will be reached. To enhance your standard of living also, but to because today's 1 lakh is not tomorrow's 1 lakh, it will be reduced. So To enhance your standard of living, you need to invest and enjoy the investment amount after the investment amount got redeemed into successful goal point of view amount. And prepare the financial emergencies. First of all, you need to prepare financial emergencies, then only you need to invest. If without emergency fund, you can't invest, because emergency can't comes by saying you and comes, right? So first you need to maintain some amount, around 3 to 6 months of your savings into an FD or in a recurrent deposit for safety purpose. Then you can plan your savings, because if you have any emergency, you can use this amount, and after that your investment can't be disturbed. And also to manage the save and taxes effectively. Normally, to manage the saves and taxes, we plan the things to enjoy peace of mind. To normally, our major motive is to get it in a relaxed mode. So this is the major thing to invest.
Okay.
And your point is never depend on single income. Already I said that today's my time value is 3000. Even though I'm talking with you, my value is 3000, and my investment value is 6000. So total combination is 9000. But if I depend on single income, my value is only 3000. If I combine the single income into second income source, then my value got increased. Just investing into right platform and right stream and right sector. That is the major point when you are going for a second source of income. Because my total time got sold to a company from 9 to 6 or 9 to 7. I can't make second income. So the mutual fund will treat or will be created or will be sounded as a second source of income. Ideally also, you will get invested, simply sitting ideal, and one of the fund manager will manage your fund and make him to get more investment. Because if you see the growth in the fund, you automatically invest. So the point is, he develops you, because if you develop, automatically the AMC will be developed. So never based on single income, create your second income. Majorly my time is not there, so mutual fund is the platform where I can sit ideally and get it, my value will be increased. And also in the last point of view, from the last 5 years, the Sensex got 16.8, 10 years 12%, 15 years 11%, 20 years 14.5, 25 years 12, 30 years 40, 35 14.5, 40 years 15.5. All these years, then it beaten the inflation. In this 5 years, 10 years, 15 years, 20 years, 25, 30, 35, 40, in this time zone, even though it is less than 15 or less than 16, but it beaten the inflation. But our major motive is to beat the inflation. So already return generated by the investment in the stock market or the different tenures. And the point is, in every zone, the inflation got beaten. So that's the beauty of stock market.
Yes.
And also this is the Sensex chart. Normally it started at 1979, and if you go closely, you will see up and down. But when you go beyond, in a long perspective, it got increased up to that 80,000 from zero to 80,000. If you view closely, that means when you go with 1 month, 2 months, 3 months, it will be less or minus or negative returns or less returns like that. But when you go with beyond the limit, you have more value. That means if I invest 1 rupee at 1979, the 1 rupee got into 80,000 in a span of this much of years. So never go with short-term volatility. Aim for the long-term volatility and long-term growth. And also we have a goal. Without goal, we can't invest, because without goal means without having a steering and driving a car like that. So maintain your goal. That should be anything: house, flight, peaceful life, education, family, car, anything is fine. But maintain your goal, then only object it. In everything, the major part is having a goal. Then only invest according to the goal perspective. Always invest in the assets which specifies financial goal in mind. If you invest in a fund, if you invest in a stock also, you need to make that this fund or this stock will help me to reach the goal. Then only you will invest. If you come and just trade itself and buy and sell, it can't make you value. It can make you fixed income or a sample income, but it can't make you growth. So majorly goal is the point where you enters any stream, not on mutual fund, not on stocks, not on FDs, not on business, not on school, not on college, not on job also. So major point is making a goal and next planning for the goal to invest. And normally, what are the various options in mutual fund? Here, the major point is if you want, if you already have a goal and you don't have time, because I already occupied with a job, I don't have time to manage a business or something else. So I simply go with mutual fund. Here, the mutual fund manager is a professional one who can manage all the stuff. And here, I can purchase gold, I can invest in gold, I can invest in stocks, I can invest in bonds, I can invest in properties, I can invest in insurance, I can invest in bank deposits. Everything is included in the single class. So in this we have different asset classes. A single mutual fund stream, we have different. If I want to buy a gold, if I want to invest in gold, so I will go to mutual fund gold ETFs or gold mutual funds. If I want to go with stocks, I will go to equity mutual funds. If I want bonds, I will go to gilt bonds or gilt corporate bonds like that. If I want property, I will go to real estate trust funds. If I want to go for insurance, I will go to insurance funds. If I want to make a things in bank deposits, I will invest in banks. That means I will deposit the money, they will lend to the lenders and they will give the interest amount, and the interest amount will be the fixed income for everything in my livelihood. So everything is interlinked and also included in the mutual fund itself. So this is the beauty of mutual fund, which is included all the stuff in a single platform. Normally, make your investment work for you means first it should be looks like inflation to beat and income where it need to be provided and easy to access and easy to usability, because buying and selling should be easy, and grow in value is also major thing, and appreciate over time, because the money should be growed, and after that realizing it a fair value and low cost, because in mutual fund we have low cost expense ratios and with the variable fair value. The main point is selecting the mutual fund is the major task. It will beat the inflation, it gives income for our needs, and it is accessible, can buy and sell easily in a tips of my hands, and it will grow our value with the appreciation of time. If you give time, automatically it will grow, and it is in fair value and also it low cost, because the mutual fund expenses is around 0.5 to 2% less than that. So it is more realistic that whenever we are going for a investment point of view to make your money work for you, these points you need to consider and then invest. And normally asset allocation should look like this, should look like some gold funds, equity funds, some bond funds. Like this, you should be allocated. Not like keeping all my money in equity, keeping all my money in small caps, keeping all my money in large caps. Not like that. So the asset allocation should look like this. You need to select one small cap. You need to select gold funds. You need to select different stream. Then only it is called asset allocation. Not investing single asset different way. For example, in ABC, the small cap company, I will invest there. Someone said that ABC company is good, so I invest there. And after 2 to 3 months, someone said that XYZ is same good company. So I will redeem the amount of ABC company and come to XYZ company to invest, and that is not good because it is not giving you value. It is wasting the time. You are normally you are managing the time or you are timing the time. Timing the time is not the thing when you are going with mutual fund. Giving time is the main point, not timing the time. Asset allocation should looks like this. That's the major point. Everything should be included. Then only it called asset allocation. If you go with only single fund, it can't say that asset allocation is good because you know that if gold increases, stock market will be decreased. If stock market decreases, automatically gold price will be increases. So if you do like some gold fund, some growth funds or some debt funds, then all the funds will be managed and you will be in a low loss or low profit when market is down because of this. If you put in all the stuff
Can you
in
just
single,
repeat this part alone, if you don't mind, Avinash?
sorry,
Can you elaborate on this part a little bit alone?
yeah, normally asset allocation means you not putting all your money into single fund. For example, we have different fund, large cap, small cap, gold funds. Already I said you we have these type of funds in mutual fund.
Yes.
Sorry, where is it?
No,
Yeah,
no,
we have
I've
gold.
known that. I have a good understanding on this. First about the allocation part, it was more of a detail. Just need a little more brief on allocation part. It has been more clear, but
Hmm.
thought of and little bit elaboration would be fine. That allocation part, which you are saying, is that we shouldn't invest all money in one aspect, like alone
One
in small
asset
cap,
class.
alone
Yeah,
in large
one.
cap. We should do it
Hmm.
in diversion, split
Hmm.
it according to the market value. Then
Hmm.
when large cap is down, we might gain profits from small cap and
No,
mid
no,
cap,
not small cap. No,
otherwise from
normally,
gold
no,
too.
no, no. Stocks are all are involved in the equity only. Don't feel that
Okay.
small cap down, large cap wins, large cap down, small cap wins like that. But the point is, if the stock market got crashed or stock market got uh, bullish, gold will be bearish. If gold is
Okay.
bullish, then stock is bullish. That means
Okay.
that means stock increases, gold price decreases. If gold price increases, stock decreases. Stock this is asset allocation. This is asset class. This is one asset class. This is also one asset class. Bank deposit is one asset class. Insurance is also one asset class. Property is also one asset class. Yeah, the major point is if price of gold increases, automatically stock market equity will be decreased. If stock market increases, automatically gold price will be decreased. You can go with few papers, 2 to 3 months back papers. You can check that. Otherwise, research yourself. You can came to know that because it is vice versa. So if you keep
Okay.
all your money in stocks, if stock is in downtrend, you are losing the uptrend thing. You got the point because on that day the gold is up, stock is down. If you keep only in gold and if it is down, it in downtrend, automatically stock will be in uptrend. That means small cap, large cap, mid cap, anything, all are stocks, right? So the point is stock market will be in uptrend. So you will lose that day gain. So if you maintain both in proportion of 60-40, 30-70 as per your risk appetite, 80 for 80-20 or 60 50-50 is not good, but 60-40 is good. 60-40, 70-30. Normally gold in gold 70-30 and stocks we give 70% for later entries. We give stocks for 70% and gold for 30%. For example, if you have 1 lakh, I will suggest mutual fund equity mutual fund for 70,000. I will suggest 30,000 for gold. That is the major thing. Then if it is in bullish, then no worry because it will covers the gold. If gold is in bullish, it will cover the stock. That's the allocation. If I keep the stock whole amount on the day if the it is in bearish, so I can't make the fund in a equalizer manner. So because I already put all my money into stocks, so I will face more loss. If I go with gold also in a proportion of 70-30, then my loss percentage will be decreased. Otherwise, my gain percentage will be somewhat increased because the gold saved the stock if the gold is in uptrend. That is the point.
Okay.
You got the point. Not about large cap, not about small cap. All are included in the stock itself. Whatever
Yes.
large caps, small caps, mid cap, multi caps, all are included in the stock itself. Don't treat like
Okay.
large cap increases, small cap decreases. Don't treat like small cap increases, large cap decreases like that. So stock is a asset class. Gold is asset class. Both are different classes. Bonds are different classes. If you maintain in diversification, if this is down, it will saves you. If this is down, it will saves you. Not to get more loss.
Okay.
Yeah, that is asset that is asset class. For example, this is gold. For example, if you have 1 lakh, 10% should be in stocks, otherwise 50% in stocks, 30% in gold, otherwise 50% in stocks, 20% in gold, 10% in bonds, likewise. But we are aggressive, we have time. Normally, this plan is worked for above 40 years. If you are below 40 years or equivalent to 20 to 25, you can risk it because you have more time to invest, so you can plan accordingly. That's also
Okay.
a thing. When here the point is your age, your time origin, your investment origin, and your goal affects your allocation. If you have less time,
Okay.
then I will give you more debt funds. That means if you already you are 45 or 50, equity funds not works for you. So I will give
Ye-
60% debt and 30% 60% debt and 30% equity, I mean stocks, and remaining is for gold, like that, gold or something, whatever in that stream. As per time and as per age, as per your goal, the stream will be different. Okay, here the
Got it. Got
yeah,
it.
here are the
Yes.
things for creating the value. Creating the value. Here are the things which create the income. In property, in gold, equity shares, we see growth in value. If you want income, you can go with bonds, PPF, and bank deposits like that. But whole the
What
stuff
is
is included.
PPF and NSC?
Yeah, that is also bond thing. Yeah.
Okay.
PPF, NSC, normally national pension scheme like that.
Okay.
NSC. Normally, it's a national savings certificate. It will used by government of India. So, if you invest in this, government is your guarantee, and they will take your money and they will invest in infrastructure of the India and infrastructure, health, and all the stuff, and they give you the interest, whatever as per the interest rate. Normally, it should be 8%, 9% around that, and it also beats FD, and all are included in the mutual fund itself. If you want to have a growth in value, you can go with these funds. If you want to generate income every month, you can go in this way by using this mutual fund.
Okay.
Now, normally what is mutual fund means? Pulling your money and my money into a single pool and collecting all the stuff and making the invested, and one of the fund manager will manage your fund and purchase instead of you, they will purchase stocks, they will purchase bonds, they will purchase debentures, they purchase gold, and after getting good value, they will sell. And buying and selling is taken care by them. Normally, we want to have more infrastructure to get it this type of fund, because the mutual fund asset allocation value is around 1000 crores or 2000 crores. If I have only 1 lakh, I can't maintain the infrastructure. They only purchase a analytic report every year to compare compare their scenarios or their strategies, only to compare. They,
Okay.
they normally they spend around 10 to 20 crores to buy that research document, and just they compare it. But I don't have the capacity to buy the research document with worth of 20 crores, because I have only 10 lakhs or 5 lakhs or 1 lakh only. I don't have the capacity to buy. So if I pull my money into this mutual fund, those research documents will help me to grow automatically, because normally mutual fund is not for customization. It is not made for yourself. If you want this fund, for example, HDFC I want to buy, or ICICI Bank I need to buy, mutual fund can't say that as per you. They have a strategy, they have a things, as per their strategy, as per their objective, they will sell or buy whatever they want to sell. But you need to select those objectives is matching with your objective or not, then only you can go with the mutual fund. If the objective is for example, if your objective is coming from Hyderabad to Chennai, but the mutual fund objective is going from Chennai to Hyderabad, so those are reverse. Your objective is Hyderabad to Chennai, but mutual fund objective is Chennai to Hyderabad, so you can't get the value. When you are selecting a mutual fund, you need to see their objective, and you as per their objective, your goal is satisfying or not. Then you need to match with your objective, is matching with your financial stability, risk appetite, and your financial things, and your goal, all the steps. If it is matching, then only go to that fund. And also, if you go blindly and go to the fund, and what I said, example like Hyderabad and Chennai, and you are in Chennai, Hyderabad, so you can't reach Chennai because it's going to Hyderabad. You got the point? Okay, you got a train, but the train objective is coming from Chennai to Hyderabad, but your objective is going from Hyderabad to Chennai. But he is inverse. So at the end of the stage, you can't go to Chennai because object is different. So when you are going with mutual fund, selecting of mutual fund is the major thing. So that's the thing. And mutual funds are managed by fund manager who is expertise in studying in financial market, all the stuff. And anybody with individual surplus of little amount also we can invest. With 100 rupees also we can invest in mutual fund. That's the beauty of mutual fund. If you have 100 rupees, you can invest in mutual fund. If you have 100 rupees, you can't invest in real estate. If you have 100 rupees, you can't go buy gold. But if you have 100 rupees, you can purchase a mutual fund whose objective is real estate, whose objective is gold, whose objective is stock market or shares, whose objective is debt fund. So even though with 100 rupees, you can go with mutual fund and buy whatever you want to buy. But in outside that, with 100 rupees, you can't buy you can't go buy a real estate place or real estate land. You can't buy a gold item or gold ornament. So that's the beauty here. Mutual fund invest gives the market returns, not assumed returns. Normally it is not as a assumed returns. It will give market returns every time. It is not assumed that it will get 20%, 30% like that. If the market moves well, it will give you best. If the market give you less, it will give less. But here the point is, fund manager is the major role plays to make your loss get less. Without fund manager, if you go, you will see the swing up and down. But if you go with the fund manager, and he will manage, her or his major motive is to get you value, and if it is up, it will give you more than the benchmark value. If it is down, it will give you less than the benchmark value, less than the loss, and more than the profit. And major thing, other thing is, investing in mutual fund is most cost effective because the expense ratio is 1% to 2%. or 0.5 to 2%. And if you have 100, if I have 100 rupees, the expense ratio is, for example, 0.5. That means 50 paisa. Only with 50 paisa, with the expense ratio, I can invest in the mutual fund, and I will get more value in near future. In the long term perspective, market returns have the potential to give perform better than assumed returns. Normally, if I assume 10 in the market, in long term you will get 15% or 20% also, if you stay for long term, not for short term. If I see, for example, one of the fund I invested around 2021 with a price of 88 rupees, and now the after 2025 the price is 198. That means I doubled the value. I got the double the amount. 88, now it is 198. So that is the thing. I waited for only 4 years, 21 to 25, and it got doubled within 4 years. That is the power of long term. If I see only 10% and short term and I withdraw it, I can't see that double the amount. I will see only
Yes.
1000 or 2000 profit and coming out. So if I stay for long time, the value got increased, and I got 100% returns within a span of 4 years. And also, how the mutual fund works means, investor pools their money to the fund manager, and fund manager normally invest in stocks and help generating returns. After that, distributing the returns to investor and delivering all the stuff. This is the cycle. What happens if you stay long? They will send you. They will create a value long. That is the cycle. So everything is in a cycle process. If you give the money, they will buy the stocks instead of you with their research documents and their strategies, and they will create a value of returns, and they will deliver you. If you reach your goal, you can withdraw it. If you want to get more value, you need to create an SIP part every month. Whenever you reached your goal, you can redeem it. That's normal. But if you want more value in the future, SIP is the best point to get it invested. If the market is low, automatically you will get more units. If market is up, you will get profit. In two way you have in profit journey, because only mental loss is there, no more physical loss. Mental loss means, okay, if I got loss, okay, I thought like, okay, today is loss, I will be depressed. Only a mindset thing. There is no physical damage because I not withdraw it. If I withdraw it, it will be a physical loss. And also, if I purchase in that dip also, if I get lost today and I created SIP or created a lump sum today itself, when I get a bonus something, then I get more units, and in near future it will be increased automatically. Because in previous example I said that in 2021 I purchased 88 and now it is 188, which is 100% more. Why? Because my patient worked there. The fund got 78 rupee also. The fund went to 68 rupees also. What I did, I created SIP, I created a lump sum there, I added some money there, so that averaged me and it reduced to 78 rupee. So now I am enjoying the long term growth perspective of return. And why to invest in mutual fund? Normally it is low cost, professional management is there, transparency, everything will be in transparent, and liquidity where you can sell and you can buy anytime, and risk diversification is there. Normally the fund manager will define the stocks, so he will plan the diversification. And convenience, small amount is also okay, and we have a regular body that SEBI is regulating, so we have trust that it will not to be in a bad phase, because SEBI has a regulation phase and fund manager giving diversification, and liquidity is more, we can buy and sell anytime, and it has transparency and low cost and convenience with small amount. With 100 rupees also we can invest in this stream. And structure and schemes categories, normally Normally what the structure means, we have, first of all, we have a sponsor is nothing but SBI, HDFC, ICICI, or Nippon, or Bank of India, something. They are called sponsors, and they employ trustees. Trustee is an employee in that, and also the mutual fund AMC is created with the trustee act. It is created as a trust, so that's why there is no, what we say, there is no trans, not transparency, what we say, and the company upscanning like that, because it is treated as trust. It is not company. The mutual fund is not a company, it's a trust. They have a trustee and custodian. They have trustee, asset management company is there, and it is controlled by a custodian, and they create mutual funds. Asset management company creates mutual funds, and they have agents, bankers, fund account, and registers and transfer agencies. And this is the thing who help us investors to get transparent. They will send reports, and they will send all the fun facts to us in every month. So it is a body of trust, not a company. So mutual fund is not a company, it's a trust as per Trust Act 1882. So there is no fraud happens here, because we have a 3 to 4 trustees, and we have a 40% shareholder of sponsors, and they create an asset management company. In the asset management company, they create mutual fund schemes, and to manage this AMC things, we have a custodian who can manage investors portfolio and risk profiles. After that, we have agents, and finally the main thing is investor. To grow the investor, we have a body of trust, in a body of trust, not in a body of company, with this 1882 act. Normally we have types of mutual funds. One is open-ended fund, closed-ended fund, interval funds. Open-ended fund means we can buy anywhere, anything. Today, tomorrow, day after tomorrow, we can buy or sell anytime. Closed-ended fund means it has a particular time, 3 years locking period, 4 years locking period, 5 years locking period, like that. After then only we can buy or sell. And we have interval funds. That means in interval funds, the fund manager will open the window and also close the window. Whenever the money is not sufficient, they will open the window. If the AMC capital or AMC value is more than the expected SEBI value, they will close the window. And we have active funds and passive funds. Active fund is managed by fund manager, and passive funds are managed by indexes. It is not managed by fund managers. Automatically the index, it will follow the index. As per the index returns only, it will reflect the returns. So normally if you have active fund manager, then you will get more thing, because their major motive is to beat the index. Passive funds major motive is to follow the index. If 1% or 1.5% increase happened in the fund, then that is the achievement of fund manager's active response. If the passive fund means, automatically it should follow the index. It can't give more than index, it can't give less than index. So when you going for long term, make it as active funds. When you going for risk free and safety purpose, go with passive funds. We have growth funds, income funds, and hybrid funds. Normally growth fund means it will give growth, income funds means it will give regular incomes, and when you go with hybrid funds, it will give you growth plus income. And we have streams called equity funds, debt funds, hybrid funds, and liquid funds. Equity funds is for stocks, it will invest in stocks. Debt funds is for government bonds, security bonds, and corporate bonds, treasury bonds, all the stuff. And hybrid funds is for combination of stock market plus debt funds. And liquid funds is also overnight funds we have. Normally we can invest in one day also. For one day we can invest. For 9 days we can invest. We have different schemes like that. We have 91-day scheme. We have 1 day scheme, 1 week scheme. So as per that we can invest and take it. And other funds is, we have exchange traded fund. It will traded in the stock market itself, in the market timings it will be traded. Mutual fund we can buy and sell anytime, no worry. But in ETFs, only in market times we can buy and sell the things. And gold ETFs, ELS means equity linked saving scheme. For saving your tax, ELSS funds will helpful. And retirement funds we have, and overseas funds and funds of funds. Funds of funds means normally if a fund manager is managing it, and other fund manager will pull the fund. Other manager don't manage the fund, just he pulls the fund to this fund, that's it. This fund manager will manage the fund. Here major thing is he's following this fund manager, that's the thing. His major motive is to send the money to this fund itself, and his major motive is to increase the fund growth, that's it. Hello. Hello.
Hello.
Yeah, can you hear me?
Yes, yes. I'm listening.
Yeah, fine. Anything to tell, ask? Anything to ask?
No. No, I was just visualizing the types of. Hello, Avinash, can you hear me?
Okay. What is that?
No. You are explaining the types of fund, right? Mutual funds. I was just searching what is what
Hmm. Okay, fine.
and
No.
was took a screenshot, kept for my reference, and was learning about that from your words.
Yeah, normally equity schemes and we have debt schemes, hybrid scheme. Normally, you said it, equity schemes invest in stock market, debt schemes invest in government bonds and ETFs, and hybrid schemes is for equity plus debt. And we have a solution oriented schemes for retirement and children. We have solution oriented plans also, like children's education, retirement, children's future, like that. We have different type of scheme. And other schemes, index funds and ETFs and fund of funds. Index funds means I already mentioned that this is passive fund, because this fund will follow the indexes. It don't follow the beyond index, because the major motive of the index fund is following the index itself. And ETFs is traded in the stock market in the market times, so you can buy and sell the ETFs in the same day of the market running. If the market is closed, you can't buy and sell. But in mutual fund, if the market even though closed, you can buy and sell anytime. And funds of funds means already one of the fund manager will manage a fund, and second manager will pull the money from his fund to this fund, that's it. Here the active fund manager is him, and passive manager is this manager. So this is also a stream of index fund, but it is treated as funds of fund. If the fund is active
Okay.
fund, you will get more returns.
Okay.
If fund is passive fund, if this fund is passive fund, you will see the indexes following funds. Normally every mutual fund manager don't invest in passive fund managing parts. Every time they will invest in the active fund manager portfolio. They will pull all his or her money to the active fund manager only, because every time fund of the funds is active funds only, not passive funds. Because if the major motive is follow the active fund manager, this fund of fund is the motive of following the active fund manager. The index fund is following the indexes. Growth funds or active funds major motive is the fund manager himself creates the objective, and selling, buying, all the stuff he will plan to get it grow, that's the thing. Equity schemes normally invest in equities and equity related instruments of the company, like share market, all the stuff. Seek growth in the long term, can be volatile in short term. In short term we have volatility, in long term we have growth. Suitable for investor with higher risk appetite and longer investment horizon. If you have higher risk, then only you need to go to equity, and otherwise you have longer investment zone. That means if my age is 50, I am not suitable for equity funds, because my retirement is in next 10 years. So my major motive is stability and balance, not risk and reward. If I have stability and balance, I'm convenient. If I am 25 or 30, I have more time, so I can take risk. And my age is less, and I have more origin, so my risk is high, and my origin of investment is more. So I can go with equity. Equity funds is not suitable for everyone who is more than 50 to 60. So normally I plan like already said that 70-30 or 60-40 or 80-20 like that. I will plan them accordingly. And we have a multi cap, that means 65% in equity or equity instruments you need to invest. Normally in multi cap we see large caps, small caps, and mid caps. Here we have a limitation that fund manager as per SEBI rule, fund manager should invest 25% in small cap, 25% in mid cap, 25% in small cap. So uh, uh, the fund manager is restricted about this. If a small cap fund is planning well or growing well, he can't go with the small cap because he has rule. So multi caps is not for everyone, only particular persons. So instead of multi cap, I suggest flexi caps in long term origin people, because it has a restrictions. If a fund is already managing well and doing well, he is not able to invest on that, because he has a rule that already 25% in small cap, already 25% in mid cap, already 25% in large cap. If already he invested 25% in small cap, he's not authorized to purchase this which is growing well now. So that is a drawback in multi cap. And in large cap, 80% of investment in equity fund, like Nifty 50 or Nifty 100, they will invest. And large and mid caps, 35%. Here also a restriction, 35% in investment and 35% in mid cap. So beyond this, they need to manage accordingly. And mid cap is also 65% in mid cap, small cap 65% in small cap companies. Here large cap means the market capitalization is more than 20,000 crores or like that. Mid cap means 10 to 20 crores, 10 to 10, 10 to sorry 10,000 to 20,000 crores, and small cap means less than 5 to 10,000 crores, like that. As per this strategy, the company got divided. If for example, HDFC Bank or Reliance is large cap, because their market capitalization is more than 10,000 crores or 20,000 crores or 2 lakhs crores also something, because it's more than 10 to 20,000 crores. And something like IDFC Bank is mid cap company, because its market capitalization is around below 10,000 crores. And some small cap companies like JM Power or something, their market capitalization is less than 5,000. So it is categorized accordingly. And in large cap, we have 50 companies and 100 companies. Nifty 50 we call it as, and Nifty 100 we call it in NSE. In mid cap, we have Nifty 150, and in small cap we have Nifty 250. That means in large cap we have 50 companies to invest or 100 companies to invest, first 50 and first 100, otherwise we can say large cap means first 50 companies or first 100 companies, and mid cap means next 150 companies. Small cap means after this 150 remaining 250, that means totally 500. This 500 is included in this multi cap, and also in flexi cap also. See, here the point is, ended dynamically. He can change the fund automatically as per his wish. There is no restriction. In multi cap, we have a restriction that 65% investment in equity instruments. That's the major thing. So flexi cap is different to multi cap, because the fund manager has more flexibility, but multi cap fund has less flexibility. And here the origin is 50 companies, next 150 companies, and next 250 companies. Total is 500 companies, and it will track Nifty 500. It also track Nifty 500, but flexibility is there. He can invest in n number of companies, but here the restriction is in a particular part, only particular percentage you need to invest, not more than that. That's something. And we have dividend yield funds also. If you want to get any dividend when the AMC company announces, if you invest in this fund, they will give you dividend when they announce. And we have a value funds, and value fund strategies with at least 65% in stocks. The point is value funds and growth funds are different. Value funds will give you value, will give you growth, and value funds give you value. In growth funds, normally we see high PE ratio, all the stuff. That means in a overbought zone or overvaluation zone. In value funds, the funds are in low.
Avinash,
Sorry.
sorry to interrupt.
Yes.
How long this presentation is going to take?
Sorry.
How long this presentation is going to take?
Percentage means?
No. How long will it take to end this presentation? Just I'm asking.
5 minutes. Just 5 minutes.
Okay.
Just
Sorry, because I've got some works running on. They have been calling me from last half an hour.
Yeah, 5 minutes. That's
I
fine.
didn't take because of the meetings. Don't mind me. Sorry.
Yeah. At least, yeah. Normally, these are the thing. Focus funds, focusing only particular funds on 30 funds, and sectoral fund means only sector, IT sector, health sector, pharmacy sector, like this. Only invest in this sector. 80% of investment should be in particular sector. ALS means 8% in stocks, but it is for savings thing. And in ELS is for saving scheme 1,50,000 with under 80C, it will use the thing, and locking period is there. So that is the thing. If you want to go with ELS funds, so we need to pay the locking period in periodically, as per helping generate market linked returns only. It will generate market linked returns. Debt funds, and these are debt funds, invest in long term, all the stuff. And we already, I said you right, overnight fund is for 1 day fund. If you invest for 1 day, it will give you value 1 day also. Money market, long duration, short duration, dynamic fund, medium short term duration, all the stuffs are there. And these are the debt funds in liquidity fund, money market fund. Here we can invest in government bonds, and normally RBI, something banks will lend money from us, and they will give loans to lenders here in the money market. They pay us the interest what they proportionated, so accordingly we get the interest. And these are dynamic funds, and hybrid funds are combination already mentioned. And these are the things balanced and dynamics solutions, and retirement and index funds, ETFs, fund of funds, all the stuff is there. These are the solution oriented funds. If you want retirement, you need to go with retirement funds. If you want children future, you need to go to children future. Index funds and ETFs is for tracking indexes, following the indexes. And funds of funds, in the funds of funds, so we can invest in overseas also. That means you can invest in US market, UK market, all the stuff by using these funds of funds. Portfolio replication, the index aims to provide the return in line of index, suitable for investors seeking returns similar to index. Normally, index funds is for suitability for index. It will follow the index. That's it. All the things I covered it. Already I covered it. Yes, I already covered. Yes, I covered. I said this. Alternate funds means investing in NSE and selling in. Buying in NSE and selling in. Yeah, normally, arbitrage fund means buying in one market and selling in other market, like buying in NSE and selling in BSC. Otherwise, buying in BSC and selling in NSE. And if you want these funds, you have that fund also.
Okay.
Arbitrage funds, and this is the riskometer. Normally, every fund will show the riskometer because the equity scheme high returns or high risk, moderate is for moderate risk, low return is for low risk and low return and low risk. This will tell you that the riskometer will tell you how much the return or how much the risk will be. By seeing this, I can say okay, this is risky. By seeing this, I can say this is a high return fund, like that, by using this scheme. And these are the documentation part, standard documentation. This is the fun fact. Every month we'll get a fun fact sheet, from the consolidated mutual fund company, plan option and regular plan and direct plan. If you have a advisor like me, you can go with regular funds. If you have a good knowledge in mutual fund, you can go with direct funds. If you go with direct fund without advisor, then you will be trapped because blindly going to direct fund without any knowledge, the fund of your will be trapped. And if you have a regular fund with advisor, then it's good. If you have a regular fund without advisor, that is bad. That means banks automatically provide phone pay, give regular funds like that. So don't go with this type of regular funds. If you have advisor, go with her or his regular plans, and they will plan you. They will give good return portfolio, and they will plan your portfolio, risk balance, all the stuff they do. So by going with investors point of view, regular fund is best when you have a advisor, and advisor will plan you. If you are going with direct plan, you should have good knowledge, then only you need to go to direct funds. Here in the regular funds, the expense ratio is little bit more when compared to direct fund, because here the risk taker is you and risk balancer is you. But here the risk taker and risk balancer, all the stuff, advisor will take care. So expenses will be more when compared to direct funds. And growth options and income capitalization, already I mentioned you that growth funds is for growth suitability, and income distribution is for income capital withdrawal, all those stuff. So, yeah, systematic investment already mentioned. This is the power of SIP normally. If I invest starting age at 25, I ended with 23 lakhs. If I want the same value in 30 years, I need to
Now,
invest.
Kalla,
Yeah, same thing.
Malana.
Yeah, how here the rupee cost averaging happens. Normally, when market is down, you will get less price. If market is, if you invest in single term, you will get this value. If you go with SIP, you will get this value. So because you are marketing the thing and you are creating a cost averaging steps here. Yeah, by this I can complete. Yeah, these are already discussed. KFC things, all the stuff. Net asset value. Yeah, fine. Yeah, all of them. We have SEBI, and in SEBI we have scores. If you have an issue, we can contact them and we can get resolution. And we have a knowledge session in the SEBI. It's called Wealth. SEBI app is app name is Sati. In that you can get the knowledge, all the stuff. And by this, I can complete a session. If you have anything, you can ask me.
Okay, no, it was a really great session. A vast, diverse knowledge. I had a little bit knowledge on mutual funds, but I didn't know it is this much deep. And I think I have more parts to cover. By with your help, I had to discover it has been a very, very long path and a very vast topic to cover.
Hmm.
It's more of an detail and more of an solutions how you have framed it, what are the types you have covered. It was very much in detail and very much helpful who doesn't know a bit about mutual funds. I know a little bit about mutual funds, but from your presentation I was like in child who I just known like an a in an alphabet. There are more 25 more to gasp. It has been so much more. And also like to request you that if you can send me the presentation, I can also go through it once again with my own time and pace
Yeah, okay.
also,
Yeah, fine.
if you don't mind that.
Yeah, yeah, fine. Yes. Yeah, thank you. Thank you very much, and thanks for your time.
Yes, thank you so much for your time and
Yeah.
your efforts.
Yeah, thank you.
Thank you.